Welcome back. I know it's been a while, but for those of you who don't know, my wife and I, we had our first baby a few months ago, and it's been great. Mom's healthy, baby's healthy, but there hasn't really been any time left over for me to focus on the channel after, my real job and then taking care of the baby and everything. So in case there's another large gap in between videos, what I wanted to do is put out kind of an all-encompassing big investing checklist video in honor of Charlie Munger, who, for those of you who didn't know, he just celebrated his 99th birthday on January 1st, 2023. So checklists are very important to me. I work in hazardous chemical manufacturing, and checklists are everywhere where I work. The quote from Charlie up top that applies to aviation, and what you'll see consistently is that anywhere that has very bad consequences if things go wrong, you'll see checklists being used. And the reason is that they work. And if you're really trying to protect against downside risk, then checklists are a key component. So why not use that for investing, right? So that's what I'm gonna do in this video. Before we start though, I wanna just show you, this is from Charlie Munger's book here, not his book, but Poor Charlie's Almanac. And this is a question that came up on how they evaluate acquisition candidates. So Charlie's answer was, we're light on financial yardsticks, but they apply a lot of subjective criteria. Can they trust management? Can it harm their reputation? What can go wrong? Do we understand the business? Does it require continuous capital infusions to keep it going? And then what's the expected cash flow? He also says, look, we don't expect linear growth. Cyclicality is fine as long as the price is appropriate. All right, so with that being said, the way I'm going to break this video down is really 4 different categories. We're going to look at the financials, which is something that if you've watched this channel before, you're super familiar with. Then we're going to look into the business and see what specific questions you want to ask yourself when evaluating an investment. And then we're going to look at management, which I think is one of the most important ones. It's definitely the one that's had the biggest impact on my investments. And then lastly, valuation, which I think is the least important and the easiest, but that's why we're end on it. So the first thing we're going to look at is the financial side of the checklist, and I'm going to use Google's 10Qs and 10Ks to kind of show this. So let me pull that up. Okay, so this is going to be all of Google's financial data for every quarter going back to 2015. And basically, we're going to just look at it this way because I think it's easier to really see trends and patterns whenever you look at graphs as opposed to looking at tables and numbers. So the first thing I'm going to look at is, are they growing earnings per share? Now, growth is not essential whenever you're investing in a company, but it makes it a lot easier to invest in something if they have some form of growth, especially like double-digit growth, all right? So what I'll do is I'll look at the earnings per share. So let's say that this is from 2017 to 2023, so that's 6 years. So in 6 years, they went from 40 cents to $1. So what I do up here in the calculator is I'll do 1 divided by 0.4. So they went up 2.5 times in those 6 years. And then I raise that to the 1/6 because it was 6 years. And that gives me an annualized growth rate. So they're growing at 16% a year, their earnings per share. And that's even accounting for them coming down from this peak. So that's good. The higher the growth, the better, obviously. I think above 7-8%, you're usually safe, but double digits really nice. All right, so the next thing we're going to look at is the tangible book value. And I'm going to go to the balance sheet for that one. So why is tangible book value per share important to me? Assuming the company's not paying dividends, if they're making money, it has to show up somewhere on this graph. If they're building tangible wealth for the shareholders, right? You want to see, and I don't care what the price per book is, I just like to see it growing. If a company's making money, I want to see that tangible book value is actually growing on a per share basis. If they're paying dividends, this isn't as important because they have money leaving the company going into the shareholders' pocket. But if they aren't paying dividends and they're keeping all the money internally or doing share buybacks, I like to look at this graph to make sure that I'm not missing something, because I have seen companies that are making a lot of money on paper and you look at their tangible book value per share and it's just flat and you're like, what's going on? And I think that's a red flag. So this would also be a check. All right, the next thing is to look at either return on assets, return on invested capital, or return on equity. Now, personally, I think the first two are better, return on assets and return on invested capital, because I think that you can get fooled by return on equity if a company has a lot of debt. So we'll look at return on invested capital. Oh, that's tangible book value. Return on invested capital. So return on invested capital is the net income of the company divided by the equity plus the interest-bearing liabilities. So it's like how much capital is invested here and how much money are we making on that capital. Here, double digit is awesome. You could see they're really high, I mean in the 25%, but historically around 15%, which would also be good. So that would get a check for me as well. All right, next we're going to look at the debt load. And there are a few ways to do this. I'm actually going to pull up the 10Q to kind of show you the different calculations so that you can do it without using like some kind of Excel sheet like this. All right, so let me pull up their 10Q. Okay, so this is Google's 10Q or Alphabet's 10Q. First, we're going to go to the balance sheet. All right, so if we were going to calculate the debt load, there are really kind of three ways I like to do it. You can look at the debt in bulk, and that's like the debt to equity ratio. What I do is I do total liabilities divided by equity. So in this case, it would be this number, this 107.6 or 108, let's call it, divided by 252. So 108 divided by 252, you see their debt to equity ratio is going to be 0.43. Okay, so that's really good. In my opinion, less than one's good. If you look at the book definition or the business school definition, I think they say like less than 2.5. I didn't go to business school, but I like less than 1. I just prefer to be more conservative whenever it comes to debt, but that's just me. All right, another calculation you can do is to look at the current ratio. So basically all you're looking at is current assets and current liabilities. So current assets are all your assets that are either in cash or due to become cash within the year. And then current liabilities is going to be cash you owe in the next year or so. So basically you just divide the total current assets by the total current liabilities and really make sure it's more than 1. So that'd be a check. There are some exceptions to this rule, but usually the good businesses, it's always going to be greater than 1 here. And you can see theirs is going to be closer to 3, right? 188 divided by 64. All right, and then the last one, and this one's neat too because this is a way to check debt load, but this way you factor in the actual interest rate on their debt. So what you do is you take, you got to go look at their income statement, and you're going to take their interest expense and divide that by their total operating income. And that shows you like, okay, what percentage of their operating income are they having to give to their debt holders, okay? And so I'm looking for interest expense, and they don't have it here, so it's probably listed under other income. So let me Control F the 10Q interest expense. Okay, here we go. Interest expense for 9 months is $267. So if I scroll back up to the income statement, let me go all the way to the top, okay. Income statement, I'm going to take that 267 and I'm going to divide by the total operating income for those 9 months. So income from operations, 56,682. Oh, this one's going to be tiny, 56,682. All right, so this is 0.47%. So 0.5% of their operating income is going to interest payments. That's like so small. That's awesome. I like to see this in single digits. So they're probably 20 times better than I would be okay with. Okay, so that's the debt load. I'm going to go back to the financials here. I'm going to show you something I like to look at with free cash flow. And that is free cash flow conversion. So this is another one that if you Google it, the business school definition is like, free cash flow conversion is free cash flow divided by EBITDA. I think that's stupid. I would use free cash flow divided by net income, and that's what I used here. And I like to see this at least consistent, but above, let's say, 70-80%, and they're there. What you want to look out for here are companies that are making a lot of money, but they really don't generate that much cash. And that would be kind of that question that Charlie asked, if you remember at the beginning of the video, where he said, does the company require a lot of capital infusion to keep it going? Because like low free cash flow to me consistently would mean that you have to consistently have high capital expenditures just to tread water, and that's terrible. So that's what we're looking out for here. This would get a check as well. All right, so that's it for the financials. Let's move to the business section. So for business, I want to look at competition moat first of all, right? I want to look at the existing competition. Do we think that the status quo is going to remain, or do we think that there's a competitor that has some advantage on them that can take some market share? The other question is the fresh start. Okay, so fresh start, what do I mean by this? Well, then there's this really neat thought experiment I like to do, and it goes something like this. Okay, Amazon, let's take Amazon for an example. They're, $900 billion market cap right now? So if I gave you $900 billion, do you see a path that you could replace the Amazon empire? I think that's a great thought experiment. It really gives you an idea for how strong their moat or brand name is, right? The other thing to be aware of here is, especially if you're investing in small cap companies, is if a company has a high return on invested capital, be very cautious of fresh companies, fresh competitors, right? Because if they're a small business and they're making high return on invested capital, that means that it wouldn't cost somebody that much to try to compete with them, right? Because in their mind, if they invest in a startup in this field, they're going to make a high return on capital. That's just something to keep in mind. All right, the other thing is new tech. I think there are classic examples of that with, stocks like that. There's the obvious ones like Polaroid, Xerox, Kodak, Then I would say there's some really nuanced ones too that you need to keep in mind. And a great example of this is one that I just heard from Mohnish Pabrai, where there was this parking lot or parking garage outside of LAX that consistently got more cars in it than the surrounding lots. And the reason had to do with all these intangibles that they did with the cars, or just how they accommodated people. It had a moat, right? And everything was good there. He always said he thought it was a great business. However, with the rise of Uber, all of a sudden that parking lot's empty because people are not parking at the airports anymore. They're getting Ubered or lifted to the airports. Okay, so that's one example. The other competition note I would say is make sure, can this business be replaced by some low-cost manufacturer from, China, India, somewhere like that, okay? Great example here would be Dexter Shoe. That was a big investment that Berkshire made that was then knocked out by low-cost Chinese competitor, right? All right, and then another one I like to ask myself is I put big boys, meaning the big macro cap stocks, okay? So I put AAA for Amazon, Alphabet, and Apple. And one example that comes to mind here is actually Garmin. I've done a video on them, and Garmin's interesting because they hit all the boxes for like what should be a good investment, right? But I just can't get over this idea that their primary competitor is Apple and the Apple Watch. And like, if you're this small company and you're like facing Apple, that's just that give me nightmares, right? So I don't really like that. So that's one of the reasons I've stayed away from that one. All right, moving past competition, you got to ask yourself the government question, right? You got to ask, is it likely or is it a possibility even that the government imposes regulations that would have a significant impact on future earnings, okay? The first one that comes to mind here is Smith & Wesson. Other examples are probably like any Chinese stock, and it's really the reason why I've stayed away from Chinese companies is because I don't even know that government, right? So that's a huge portion of that equation if you're going to invest in China. And if you can't answer that question, in my opinion, it makes it hard to invest. Okay, next is going to be runway, and this is not like how much you think a company's going to grow as much as it is like, is there capacity for this company to grow? Okay, so I really kind of broke it down into 4 areas that a company can grow earnings. You got market share. They can take away market share. They can get a bigger piece of the pie. Then you have pie growth. So the whole industry can grow. One example of pie growth, I think, in the upcoming years. Now, this is, forward-looking statement, right? But I really think of a company like Micron, where they're making memory devices for data, where data is growing exponentially, and Moore's law is really slowing down on the supply side. So you could see a pie growth there. Repeat purchases. This is something I'm not sure how important it is, but personally, like, I don't feel great about investing in a company like Sleep Number or anybody that sells people something that they're going to last 20, 30 years. It's one of the reasons I stayed away from Sleep Number. I just don't see how they get consistent income, but anyway, that's just me. Some people might be okay with that. And the last one is subscription. You think there's potential for any subscription revenue in the future or something like that? Not all of these have to be checks. If all of these are checks, you're probably looking at a unicorn, not a real stock. But I like to see at least 1 or 2 of those that I think gives a good runway for growth. All right, and then lastly, I want to talk about cyclical businesses, because a huge portion of businesses are cyclical, and the ones I've invested in recently have almost all been cyclical or commodity stocks. But really, with cyclical companies, there's a few things then that you really need to look at. Okay, the first one is to review the financials again, this time with the trough earnings in mind, not the peak earnings, the trough earnings, and make sure you're still okay holding it through trough earnings periods. And then look at the debt again, okay? The next one is capital allocation. So I really want to make sure that a cyclical company is allocating capital wisely at the top of the cycle, that at the top of the cycle, they're using the money to return value to shareholders or prep for the bottom. I think a great example of this is what the oil companies are doing right now, where previously oil companies, whenever the price of oil went up, they just used all their money to invest in new exploration. Whenever they did that, they drove the price of oil down because they oversupplied, and now they're back at the bottom of the cycle, okay? Whereas recently, a lot of oil companies like Chevron have been using the top of the cycle to return value to shareholders through repurchases or dividends, okay? The other thing I like to ask myself if it's a cyclical company is, do I see some kind of supply-demand imbalance moving forward? I'd go back to the Micron example that I talked about earlier. And then lastly, look at the debt again. Okay, I think that is super important because for cyclical companies, it is not if there's going to be a downturn and period of low earnings, it's when there's going to be a downturn and period of low earnings. And you need to make sure that they don't have an unreasonable amount of debt that's going to sink them if it dips too low, right? If their earnings dip too low. Okay, so that's it for the business section. I'm going to talk about management now, okay? So there's really 3 things I'm paying attention to whenever I'm trying to evaluate management. The first one is that they do acknowledge some sort of share price discount, and they can do that directly by calling it out, or they can have some sort of insider ownership, or be using the company's own money to buy back shares. I feel like those are all good signs. The next one is real goals and progress towards those goals, not moving goalposts. And I'm going to give examples of all this through earnings transcripts. I just want to review them first. And then the last one is to be transparent about their capital allocation for the future. Because if a company doesn't have plans for how it's going to spend money that it gets in the future, like, how do you trust them to do wise stuff with money once it comes to them, right? Okay, so I'm gonna give you a few examples of this. The first one's gonna be USA Truck. So USA Truck was actually my largest position before they were bought out. And we probably had too much of our net worth in USA Truck, but that's, worked out for us. But one of the reasons why I was so confident to put a large percentage of our net worth there was because of how I felt about management. They were very transparent. And one example of that was this goal that they set forth. Let's see. Yeah, so they set a strategic update or strategic goal that they wanted to be over $1 billion and then have earnings per share between $4.25 and $4.50 by 2024. Now, keep in mind, at the time, the stock was selling for like $13. So selling for $13, they said that they're going to be making, $4.50 in 2 years. Okay, there's a reason it was bought out. But more importantly than just acknowledging the goal, they were making like real progress. Here, look, they were way ahead of schedule on those outcomes, and it was evident. They were probably going to hit it a year early, to be honest. Another example I'm going to use is Atcore. And this one is about the capital allocation strategies. So Atcore, and I have a video on them. Atcore is a huge position of mine as well. It's probably my largest or second largest position right now. So they are very transparent about how they're going to use capital, right? So they have capital expenditure criteria, and they even give you, they expect it to be within 3 to 4% of net sales. Next is mergers and acquisitions. And they've actually been very transparent about, criteria for mergers and acquisitions and like what kind of prices they're looking to pay for them. So I really appreciate that. And then lastly, stock repurchases. And, I love that. So anyway, and if you look at this, you'll see there's a lot more dedicated to stock buybacks, 1.3 billion versus like 200 for just CapEx, right? So that's a really good sign. All right, and then lastly, I want to show you one more example of this transparency, and this is actually from Mosaic's earnings call. This is another stock I own. They're in the fertilizer business. Okay, so they had said before that they had contemplated a special dividend or more buybacks, and so they got this question from this JP Morgan Chase analyst. He says, you said you were contemplating a special dividend. Why would you do that given your low valuation and high free cash flow? Great question, okay? The president and CEO's answer, so far we have been definitely focused on buybacks, and the main reason is exactly what you say. We believe our shares offer as good a value as anything we can think of, okay? I know that all of this sounds like obvious and simple, but you'd be surprised how many companies just don't talk like this. Don't talk about capital allocation, about returning value to shareholder, about doing buybacks based on the price. Those things are super important to me, okay? So lastly, we're going to go to valuation. So for valuation, what I wanted to do was show you really the only 3 things you need to know if you're going to get a rough estimate for what your rate of return is going to be, right? You want to know what PE are you buying it at? What do you expect the earnings per share to grow at? And then what PE are you planning to sell it at? Or if you're not going to sell it, what PE is it going to be sitting at some years from now or something like that? The way this graph works is it says, okay, on the yearly return column, it's like after 1 year, if you bought it for PE of 10, it grew 10% earnings, and you sold it for PE of 12, you'd have a 32% return. If you waited till 8 years and you bought a PE of 10, and then 8 years later, after 10% growth, you sold for 12, you'd have averaged a 13% yearly return or gotten an overall return of 157%, okay? This is a great tool just for estimating like how much growth really impacts it. Even if you buy something at a super high PE of 20, if it's growing, 14% and you're going to sell it at a lower PE of 15, even if you hold this for 10 years, you're still making 178% on your money, right? Like, it's really good. Now, the first 2 years, you're not going to make money if it falls to that 15 PE, but growth is huge, okay? So the question I like to ask myself with valuation is pretty simple. It's like, am I doubling my money by year 5? Am I tripling it by year 10? Am I getting 10x by year 20? So that works out to a rate of return about 12 to 15%. Over time, and I just think that's a good way to think about it. One thing to be super cautious of here is overestimating this growth rate, it has a huge impact on valuation, right? I would say think of whatever growth rate you're going to get and then half it. So even if you think it's going to grow at 14%, put a 7 there and then see if the math still works out to where you're happy with it. But that's really it for valuation. I think valuation is the easiest. And if a company really checks all the boxes on the first 3 sections, the financials, the business, and the management, I think that you're just looking here to make sure it's not grossly overpriced. I think the examples of those would be Chipotle. That's one. Great company, great food, super expensive stock. I think the PE is like 50 or 60 or something crazy. Another example is Costco. Sorry, Charlie. You know what's funny is I'm actually going to Costco like right after I finish this video, and I love the company. Stock's great. Like I said, it has all the 3 boxes, before valuation, but it's just the PE is way too high, I think, right now. That's all I got. I hope you enjoyed it. I hope you learned something. Like and subscribe. I don't know when I'll see you again, but I'll see you next time.